For decades, the cultural script has been simple: save up a down payment, secure a mortgage, and settle into long-term financial stability. When making that leap, the math usually centers on two primary numbers: the listing price of the property and the projected monthly mortgage payment. But behind that monthly payment exists a shadow ledger, a series of unadvertised expenses that quietly pull from your bank account long after the contract is signed. A house is a physical structure, but on paper, it is a complex financial liability that requires constant capital to maintain. Failing to look past the sticker price can turn a symbol of security into a significant and persistent financial burden. The reality of this ledger usually reveals itself on the final day of the transaction, right at the closing table. This is the first tier of hidden costs. Before you are handed the keys, you are required to produce thousands of dollars in immediate cash to cover closing costs. We start with the 20% down payment, then loan and fees, title services, insurance, and prepaid taxes stack directly on top. A buyer preparing only for a down payment suddenly discovers they are short, needing thousands in unbudgeted cash. This upfront trap means the financial bleeding begins before a single piece of furniture is moved into the house. Once the initial transaction is over, the focus shifts to the daily reality of the first few years in the home. Buyers often take comfort in their 30-year fixed-rate mortgage, believing they have permanently stabilized their monthly housing expenses. This flat line represents the fixed mortgage. Above it, taxes and insurance aggressively climb as budgets and risks escalate. Unlike a renter, an owner's sudden physical failures drop straight to the bottom line as spikes of emergency maintenance. Because every structure degrades over time, homeowners must maintain a dedicated maintenance budget to handle these inevitable physical failures. Between taxes, insurance, and repairs, the actual price of keeping your home increases every single year, regardless of your fixed interest rate. Beyond the literal monthly bills and physical repairs, a home extracts value in a much more abstract way. The capital used for the down payment, along with the equity built up over time, introduces a significant opportunity cost. On the left, tens of thousands of dollars are frozen inside the physical structure of a property. On the right, that same liquidity dynamically flows into diversified investments. This lack of liquidity often stems from purchasing the largest home you qualify for. Larger square footage guarantees higher utility bills, more rooms to furnish, and a drastically expanded footprint to continuously actively maintain. There is a wide gap between what a lending institution defines as qualified and what a buyer defines as comfortably affordable.
Over-leveraging space for status locks away your liquid wealth and restricts your long-term financial flexibility. So, does this hidden math mean that buying a home is a mistake? No. Homeownership remains one of the most significant financial decisions a person can make, provided that decision is rooted in reality. The most devastating real estate mistakes happen when buyers blind themselves with the sticker price and choose to ignore the hidden costs. Financial freedom in real estate is buying a home where the mortgage, taxes, maintenance, and surprises fit comfortably within your existing means. This freedom is found in successfully owning a home rather than allowing the financial burden of a home to own you.